Hi, and welcome back again to Tim Bigham's Options and Volatility Newsletter. Taking a look today at our latest trade, a vol capture trade on JFrog, FROG, right? Where some big time option volume, unusual option activity, spikes implied volatility, sets up ideally for a vol capture trade with Edge. So let's jump in and take a look, shall we? First of all, here is the scanners that we like to use. Here's the custom-made one I built on Thinkorswim. Here is one from a different website, but this is from September 4th here. As you can see, JFrog made the list, so a big pop in implied volatility, almost a 40% vol change, right, for JFrog. You can see big, unusual option activity too, over 13,000 options traded versus about 1,500 on average. Same sort of scenario here, JFrog, where it hit the list as far as a spike in implied volatility and unusual option activity. Just how big a spike in implied volatility? Pulled off the vol charts here and kind of just distilled it down to a 30 and 90 day slightly out of the money call. IV lifted across both puts and calls and every expiration term structure volatility lifted. But you can see over the past several weeks, implied volatility basically painted at that mid 30 level for both the 30 and 90 day options. But we'll see in a second that the big option volume that came in on September 4th spiked that implied volatility to extremes, setting up ideally for a vol capture trade. And this is post earnings as well. Just how big a spike. Here is the day going back to August 30th, right? Stock was trading at 27.75. IV, as we said, right around that mid 30 level, around 35, right? Light 70 contracts traded on these SEP 30 calls versus open interest of 614, so certainly not a heavily traded option. You can see going back to August 30th, right, the September 30 straddle, which had 21 days to expiration, could have been sold for about $2.65, give or take, with the IV right around 35. This certainly would have been an in the money, right, a bullish trade to sell a 30 straddle with the stock at 27.75. The put we're selling, right, in the money by a decent amount. The call well out of the money. You can see both by the pricing and the delta. So selling about an 80 delta, selling a 20 delta, you'd be about 60 deltas net long. So a fairly bullish trade, which makes sense. You're selling an in the money put. Let's fast forward to the day of the big volume. Here you can see, first of all, that big volume, over 8,000 now of the September 30 calls traded on September 4th, right? Versus, again, open interest less than 600. So this is the epitome of unusual option activity, to say the least. You can also see implied volatility now well over 60. Remember before it was painted at that 35 level, spiked to well over 60. We can also see what happened to that straddle, right? That September 30 straddle, if we go back here, which previously was trading at about $2.65, right? But because of this huge lift in IV, it jumped to $3.90, even with the stock moving higher by 86 cents, right? So the stock moving closer to the ideal strike price of 30 is a bullish trade. Remember, we were 60 deltas net long back here. The stock goes up, you'd expect that to be a profitable trade, right? And that straddle that we sold, the put especially, we sold to come down in price. Instead, we see, because of this big unusual option activity, this huge jump in implied volatility, that straddle get more expensive, right? Because the IV now is over 60 before it was at 35. Still a bullish trade, right? We're still selling an in the money put and out of the money call. The delta would still be 17. Somewhat overstated too, because a jump in implied volatility brings all the deltas towards 50, right? So all the options basically that are out of the money carry a slightly higher delta at higher implied volatility levels, right? As all the deltas basically congregate more towards 50. So taking a look at things, we would have had about a 38 and a half smooth delta. That's simply gotten by taking the current delta on the sell straddle of 17 and the previous one at 60. And you'd expect, right, with the stock up 86 cents, right, the delta gain on the trade would have been, just from a delta standpoint, about 33 cents, right? We're long deltas, right? The stock goes up, you'd expect to make some money on that trade. We do have positive theta, right? The theta on the trade is 5 on the calls, 7 on the puts, right? So you expect theta to be about 12 cents. We had 2 days of theta from the original August 30th trade, right, to the September 4th. So you expect about a 24-cent gain in theta or time decay, right? So you expect the straddle price, given everything, right? It was priced at 267 and change, but the stock moved up, which would lower the price of the straddle. Time passed, which would lower the price of the sell straddle, right? You'd expect the straddle price to be trading somewhere around 220. Instead, it's close to $4. Provides a very nice $1.67 edge on this trade. Another way to look at it, the stock price went up 86 cents, right, from our August 30th comparative date to September 4th, but the straddle price went up more than the stock price, right? Even though the straddle price should have shrunk in price, the stock got closer to the $30 strike price. You'd expect the straddle to go down. The implied delta, if you will, on that straddle is well over 1, right? That's simply taken by the movement of the straddle price versus the stock price here. So certainly some big edge going out and selling this straddle for a higher price, when both from a time decay and delta perspective, it should have gotten cheaper, but because of that big option volume, right, spiking implied volatility, it got much more expensive. We can also take a look at it from a slightly different trade, looking at the strangle price, right? Instead of doing a straddle, it's slightly safer trade, right? So we're selling, in this case, slightly out of the money, 27.50 puts, and then well out of the money, 32 and a half calls on August 30th, right? The stock was at 27.75. That strangle was trading right around 85 cents. The IV just over 36, right? And this would be a bullish trade as well, right? Selling a negative 43 delta and then selling a 5 delta on the call. So it would be 38 deltas net long. Fast forward to September 4th, the stock again up 86 cents, right? We're net long. We're still net long, right, on this strangle, right? Because again, the stock's at 28.61. The puts are a little bit further out of the money, but the calls are still well out of the money. So you'd expect that strangle, right, to come down in price. We had the same sort of theta, right? 4 cents on the calls and puts, so 8 cents. So you'd expect about a 16-cent theta gain on the trade. You'd expect the delta gain having a bullish sell strangle on the stock going up in price, right? The smooth delta on that strangle is about 25, right? With the stock up 86 cents, you'd expect that strangle to be profitable by 21 cents, 16 cents time decay, right? So you'd expect that strangle to improve, right, to drop in price, right, by about 37 cents. Instead, it went up 50 cents, right? We can see it went from 85 cents to $1.35. Why? Because we had this huge lift, right, in IV. The IV now about 28 vol points higher, right, than it was previously. You can see IV, just leaping off the charts, as we said, with this big option volume coming in. So you can see that strangle has a nice theoretical edge of basically 50 cents on the trade by getting into it at these levels here. Another way you can follow along with it would be a simple covered call trade, which is simply buying the stock, selling the calls. So for those who want to lean with that big call buying out there, right, you can buy the stock, sell the call, which will always benefit if the stock goes up. the straddle and the strangle are more pure kind of volatility capture trades, looking for that IV to revert back, take the trade off when it does. Here, this will benefit from the IV reversion, but it will also benefit if the stock rips to the upside, where the other trades can potentially get in trouble if you get a massive move to the upside, even though they have a very nice cushion. So here is the one example trade, the October 27.5, right, covered call. This one would have been doing it basically right at the money covered call on August 30th, right? Stock at 27.75, selling the 27.5 call, right? That buy right, it's called right, would have been priced right at $26, right? Which is buying the stock at 27.75, right? Selling the call, which closed at roughly 175. The IV on the call right around 35. You would have been about 57 deltas, selling on the call because it's slightly in the money, a little bit of time to go, right? So that buy right would have had a delta of about 43. And then fast forward to September 4th, the day of the big volume in September. And we saw some also in October as well, these October 30s. We'll take a look at that to buy right in a second, but you can see that the buy right actually cheapened even with the stock going up in price, right? So he's had the stock again moving from under 28 to well over 28. So the covered call, the buy right trade, right? Buy the stock, sell the call, should have gotten more expensive. Instead, it got cheaper. Why? Because you saw that huge lift in IV, now at 55 on these. Before, again, we were trading right at that 37 level on that trade. So again, here's a way to potentially lean more bullishly with that, call buyers out there, right? But still capture a very nice pop, able to get into the covered call trade for cheaper, even with the stock higher. Why? Because you had this huge jump in implied volatility because of that option volume. And finally, another way to look at it would be going out to the $30 strike price, right? Give yourself a little more breathing room. So our comparative date, August 30th, stock was at 27.75, right? The OCT 30 call was at 67.5 cents. That buy right would have been had the October 30 buy right, buying the stock, selling the OCT 30 call as a protective play for a little bit over 27 bucks. IV on that call was about 35. The delta on the call was 31, so that buy right delta would have been 69, stock at 27.75. Fast forward to September 4th, the day of the big call buying, right? We see the stock rise 86 cents, right? But that OCT 30 call actually went up more than the stock price, right? It was trading at, 67.5 cents midpoint, right? 60 to 75. Then the day of the big volume, you can see 140 to 190. So that jumped in price more than the stock. The implied delta on the stock was over 100. So the calls went up more than the stock, which makes absolutely no sense because they're still out of the money. Why did they go up, right? This huge jump of 20 vol points, massive jump in IV because of that big call buying that lifted implied volatility. Fancy way to say the price of the options across the whole term structure of vol. That buy right delta now staying at 55, right? But able to get into it for a somewhat cheaper price, even with the stock railing higher. So a great way to, in essence, follow along with that call buyer out there, capture the fact that they're willing to dramatically overpay to get into those options, right? Capture that implied volatility, lean bullishly with the call buying out there. So whether you're looking to do a straightforward covered call trade, buy the stock, sell these very comparatively expensive options, or more capture straightforward implied volatility by selling a straddle or strangle, doing a little bit shorter term, all of those make sense. We'll see how this one pans out, but again, the notion here is, right, you will sell the rip and then buy the dip once implied volatility, which inevitably seems to come back here. And again, this is post earnings, right? When you look at it on the chart, here were their earnings, going back August 7th, right? And the stock has made a nice move higher. You have this huge gap in earnings, gap that the earnings were not well received by the market, right? But certainly have had a nice move, and you can see that this implied volatility picked back up, starting to soften a little. I did this on Thursday, so we'll see how this fares. I'll have an update for you shortly. So hopefully provide some insight how we go about identifying potential opportunities to take advantage of these huge spikes in implied volatility by unusual option activity. Once that activity slows down, once the volume slows down, inevitably you get a reversion of implied volatility. That's when we look to cover the trade, take our profits, and move on. So until next time, as always, here's a good trading. Take care.